In today's video, we're going to be covering what is private mortgage insurance and do you, as a first-time home buyer, need to pay it with your mortgage? Welcome to Tim Lamb Mortgage, where everything is about you, the first-time home buyer. If we're meeting for the very first time, my name is Tim Lamb, and I've been a mortgage professional for the last 18 years, and my passion is assisting first-time homebuyers with the education that they need to make a confident decision in buying their very first home. Please consider subscribing and ringing the bell down below so that way you don't miss any of the education that I provide. Today's topic is private mortgage insurance, and do you need to pay it as part of your monthly mortgage payment? All right, what is private mortgage insurance and why do we need it? All right, previously when you came in to meet with a banker or a credit union, they would have required you to have a 20% down payment. All right, times have changed dramatically with the introduction of private mortgage insurance and reducing the down payment requirements that are necessary to get into your first home. Those down payment requirements could be as little as 0%, maybe 3%, 5%, or anywhere up to that 20% number or beyond. The reason that private mortgage insurance was introduced is the bankers really wanted to make sure that we had 20% equity into our house when we purchased it. But instead of having that full 20% and saving for years to get there, they introduced private mortgage insurance so that way you could pay potentially on a monthly basis PMI to protect the banker, all right, or the credit union. Essentially what we're doing here is you're paying a monthly premium, an insurance policy, to offset the risk of the bank for you defaulting on the loan. So let me go over that one more time. So essentially the bank would want a 20% down payment. In order to allow you to have less than a 20% down payment, they're gonna add private mortgage insurance to your loan to offset the risk for the bank. So I kind of think of it kind of as default insurance, protecting the bank as part of the process. It's a huge benefit to you as well because you don't have to save a full 20% down. That might not be feasible in your world. It might be feasible to save 3 or 5%, get into that house and be able to make those mortgage payments that are potentially similar to your rent, but don't have time or the wherewithal to save the 20%. So PMI was introduced to allow you to get into a home with less than a 20% down payment. All right, there's 4 different ways that we can look at the private mortgage insurance when we're considering it, all right? Most importantly, you need to get a total cost analysis to compare which one of these 4 is absolutely gonna be the best. So make sure you check in the description down below. I'm gonna have a separate video that's gonna give you an exact example of what PMI is, why you need it, and which one of these 4 options is gonna be best for you. All right, let's dive into those 4 options when it comes to private mortgage insurance. All right, the 4 of them are borrower paid monthly PMI, lender paid PMI, single premium financed or single buy, or we can do what we call a piggyback or a combo mortgage where we're dealing with a first and a second mortgage. All right, so let's dive into the very first one. Borrower paid monthly insurance premium. All right, let's assume that you're putting a 5% down payment into your transaction. You're gonna need to pay the PMI, the monthly PMI expense, until you build another 15% equity in your property for a total of 20% equity. So as soon as you get to 20% equity, you can petition to have that PMI removed. All right? A tip for you though, is the mortgage companies, the bank or the credit union, are not looking at any appreciation in your property. So if the value of your house goes up and your mortgage balance goes down, once there's a spread there of that 20%, then you can petition to have that borrower paid mortgage insurance removed. All right, option number 2 is lender paid mortgage insurance. All right, what we do in this strategy is we bump up your interest rates, let's say 1/4 to 1/2 percentage point, and we eliminate the need to pay the borrower monthly paid. So essentially what we're doing here is we're building the private mortgage insurance into your interest rates. All right, tip here, this is a very important strategy to look at depending on how long you're gonna be in your home. Because the longer that you pay the lender paid mortgage insurance interest rates, the more expensive the loan is going to be for you. So if you're thinking less than 10 years roughly, and again, we've got to look at that total cost analysis down below to figure out exactly what makes the most sense. If it's less than 10 years that you're going to be in this property, it probably makes sense, or at least for you to explore that lender paid mortgage insurance. All right, option number 3 is single paid MI, either paying it with cash or financing. All right, this is a strategy. If you've got enough reserves, you're able to pay the private mortgage insurance one time at closing. So you could write a check and not have to pay any monthly mortgage insurance, no lender paid mortgage insurance. You just pay for that premium one time at closing and you're done with it for the life of the loan. Financing it in, we can do the exact same strategy if your loan allows. We can take that one-time premium, add it to the mortgage balance, and pay that over the life of the loan. So definitely 2 really important strategies to look at. And again, I'll have it in that total cost analysis down below. The last strategy is a combo mortgage or a piggyback mortgage. Sometimes they're referenced to. This is allowing you to do a first mortgage and a second mortgage to eliminate the need for the private mortgage insurance. All right, so in this strategy, we put together your first mortgage at 80% of the purchase price. We would have a 15% second mortgage, and then we'd have a 5% down payment. All right, we've talked about having 20% equity in order to eliminate the PMI. That is how we do it with this strategy. We put the first mortgage at 80% of the purchase price, so that way there's no private mortgage insurance included. We add a second mortgage of 15%, and then you'd have a 5% down payment. All right, tip in this strategy though is interest rates on both the first and the second are going to be higher because there's more risk to the mortgage companies, the banks, or the credit unions. So make sure, again, you check out that total cost analysis down below and see what is the best scenario for you. So wrapping it up, borrower paid mortgage insurance, lender paid mortgage insurance, single premium, and or that piggyback combo scenario, all of them are perfect strategies. And depending on your situation, you need to dive into all 4, figure out what is going to be best for you, and figure out what the lowest overall cost of borrowing that money is over time. So check it out now, and we look forward to seeing you down below in that total cost analysis. As we transition here, question of the day. What is the additional question that you would like to ask me about private mortgage insurance or any other topic when it comes to being a first-time home buyer? Put those comments down below and I'll make sure to get them answered. Thank you so much for watching this video. If there's anything else that I can do, put it in the comments. I look forward to talking to you soon, and happy house hunting.